You know that feeling when you finally buy an investment and the price immediately drops? Imagine buying Bitcoin at $104,000. Institutions are finally here. BlackRock launched their ETF. Companies are buying billions. Everything says Bitcoin should be exploding higher, but instead, it stalls. It drops to $95,000, $90,000, $85,000. And you start asking the same question millions of investors are asking right now. If institutions are buying, why isn't the price going up? The answer might be something most people have never heard of. A financial structure that can legally pressure an asset price downward, and it may already be happening. Before we talk about Bitcoin, I want to tell you a story. In 1982, Mexico borrowed billions of dollars from international banks. It sounded smart at the time. The money would fund infrastructure, grow the economy, and modernize the country. But there was a problem. The debt wasn't in pesos, it was in US dollars, and Mexico can't print US dollars. So when the Federal Reserve raised interest rates, the dollar strengthened. Mexico's debt exploded. Suddenly they owed $80 billion they couldn't repay, and that's when the IMF stepped in. But the rescue came with conditions. Mexico had to privatize industries. They had to cut government spending. They had to open their markets to foreign investors. In other words, they had to sell pieces of their country to pay the banks back. This happened across dozens of countries: Argentina, Brazil, Indonesia, all caught in the same trap. It's called a debt spiral. Now here's where it gets interesting. Debt spirals don't only happen to governments, they can happen to companies too. Imagine you own a house worth $500,000. You take a home equity loan for $100,000. Payments are easy at first, but then interest rates rise. Payments double. Suddenly you're stuck. You have three options: sell the house, take on more debt, or default. None of them are good. Now scale that up. Instead of a house, imagine $60 billion worth of Bitcoin. There's a company that owns more Bitcoin than almost anyone else on Earth. That company is MicroStrategy. On paper, they're a software company. In reality, they've become something very different. A leveraged Bitcoin fund disguised as a corporation. Here's how it works. MicroStrategy raises money by selling stock, issuing convertible bonds, and issuing preferred shares. Then they take that money and buy Bitcoin. Lots of it. Today, they hold roughly 450,000 Bitcoin, worth tens of billions of dollars. But there's a catch. Those bonds and preferred shares come with obligations, interest payments, dividend payments, roughly $700 million per year. That's almost $2 million every single day. Right now, the system works because of something called a premium to net asset value. Basically, the market values MicroStrategy higher than the Bitcoin they hold. Why? Because investors expect them to keep buying more. So the cycle looks like this. They sell stock and buy Bitcoin. Bitcoin rises and the stock rises. The stock rises and they sell more shares. It's a flywheel. But flywheels only work in one direction. If the stock ever trades below the value of their Bitcoin, the system breaks. They can't raise money anymore. And suddenly, the only way to pay those obligations is selling Bitcoin. Now imagine what happens next. MicroStrategy sells Bitcoin. Bitcoin price drops. Their stock drops even more, which forces them to sell even more Bitcoin. That's the death spiral. And here's where it gets uncomfortable. Some investors may actually want that to happen. Imagine you're a major investment bank. Your clients want Bitcoin exposure, but they can't just buy it directly. Too volatile, too risky, too many regulations. But what if there was a way to buy billions of dollars worth of Bitcoin at a 20% discount? If MicroStrategy ever had to sell large amounts, they wouldn't sell on an exchange. They would do something called a block trade. They call major banks, sell billions at once, and the banks demand a discount. 10%, 15%, 20%. Suddenly, institutions are buying huge amounts of Bitcoin below market price. So how do you push a company into distress? You apply pressure. You short the stock. You publish bearish research. You create fear around the structure. Nothing illegal, just pressure. This strategy has been used before. In the early 2000s, a financing structure called pipe deals caused hundreds of companies to collapse. The lower the stock went, the more shares lenders received. So lenders had a financial incentive to push the stock price down. The result? Almost half the companies involved were wiped out. Now let's be clear, MicroStrategy is not Bitcoin. Bitcoin is decentralized. MicroStrategy is a company. If MicroStrategy struggles, that doesn't mean Bitcoin failed. It means a company used leverage. But this situation creates something interesting. If institutions are trying to accumulate Bitcoin cheaper, short-term pressure becomes long-term opportunity. Here's the difference between retail investors and professionals. Retail investors see price drops and panic. Professionals ask a different question. Why is the price dropping? If fundamentals are broken, they sell. If the price is being suppressed, they buy more. That's how wealth transfers happen in markets, not through scams, through psychology. So what happens next? Nobody knows. But we do know this. If powerful institutions are working this hard to accumulate Bitcoin, that tells you something important. They believe it has value. Because nobody engineers complex financial attacks against something they think is worthless. If you believe in the long-term thesis of Bitcoin, short-term volatility isn't a threat. It's part of the game. And the only way to win that game is understanding the rules better than the people trying to shake you out of it. If this helped you see the bigger picture behind what's happening in the market, then you're already ahead of most investors. Because the people who succeed long-term aren't the ones reacting to every price movement. They're the ones who understand the mechanics behind those movements. If you enjoyed this breakdown and want more videos that explain how money, markets, and institutions actually work, make sure to subscribe and leave a like so more people can find this kind of content. And let me know in the comments what you think. Is this just market dynamics playing out, or is there something bigger happening behind the scenes? Either way, keep learning, keep questioning, and most importantly, understand the game you're playing. I'll see you in the next video.